Hello, and thank you all for joining us today for our timely conversation on the oil market whiplash, the energy crisis, Omicron, and OPEC's response. Over the next hour, we will discuss the recent turmoil in global oil markets, the impact of the new Omicron variant, that will have on demand, and as well as how the decision of the OPEC Plus meeting will shape the market into January and beyond. My name is Randy Bell, and I'm the Director and Richard Morningstar Chair for Global Energy Security at the Global Energy Center at the Atlantic Council. I am delighted to be joined today by a distinguished panel to help unpack this complex web of oil market issues. Our panel includes Rod Al-Qadiri, the Managing Director for Energy, Climate, and Resources at the Eurasia Group; Halima Croft, Managing Director and Global Head of Commodity Strategy at RBC Capital Markets; Greg Chernow, Managing Director and Portfolio Manager at PIMCO; and Paul Sullivan, non-resident Senior Fellow here at the Atlantic Council Global Energy Center. Before we get started, just a few housekeeping items. First, you can follow us on Twitter at AC Global Energy, and you're welcome to live tweet this event using the hashtag ACEnergy. Second, this conversation is public and on the record. It's being live streamed over Zoom, YouTube, Twitter, and Facebook. It will also be available as a recording afterwards. And third, you can submit questions through the Q&A function on Zoom. I will take these throughout the program, and I'll try to get to as many of these as I can. If you're watching on another platform other than Zoom, unfortunately, we can't take your questions. So with that, let's get started. First, I want to turn to Halima to talk about the OPEC decision and what happened and what the context was for that decision. So Halima, over to you.
Great. Thank you so much. And thank you everyone who's tuning in today. And it's such an honor to be on this panel of such terrific energy market experts. I mean, yesterday, OPEC made the decision to essentially continue as planned with their 400,000 barrel a day monthly increase. They have been tapering down their large production cut that they did in the spring of 2020 in response to the COVID crisis. And there was a question mark really hanging over this meeting, given what transpired the week before with the coordinated strategic stockpile release, the United States acting in concert with key Asian consuming countries like China, India, Japan, to release collectively between 65 and 70 million barrels of production. And the news about this new COVID variant, which could potentially impact demand, there had been real question marks over whether OPEC would proceed as planned with putting those barrels on the market, or whether they would choose to invoke the pause clause, which was actually in the agreement in July, whereby which they could essentially pause a decision or pause the plan to put more barrels on the market to assess market conditions. And I think what is really important is the geopolitical context of the decision to go ahead with that increase. It came after senior US officials, most notably Amos Hochstein, who everyone at the Atlantic Council knows very well, was part of a group that went to key countries in the Gulf, including Saudi Arabia, and essentially made the case for going forward with the increase. And I think they, deployed a very deft approach whereby which, they publicly talked about the fact that they could do another SPR release as needed through the exchange mechanism, while at the same time really showing that they understood the concerns of the Gulf producers. They really did, I would say, a charm offensive in talking about the real importance of the bilateral relationship with particularly the US and Saudi Arabia. And I think that charm offensive really paid off in terms of getting the Saudis to green light the decision to go ahead with that increase. So I do think it wasn't necessarily a market decision. I think it reflected the fact that there was, a really big US ask. And the last thing I would say is that the evolution of this monthly meeting structure gives them the ability to course correct as needed. I mean, even yesterday, they essentially said, this meeting is not adjourned. We can reconvene quickly to change our policy if needed. But just the monthly meeting structure now means that OPEC Plus has the ability to much more easily come in and calibrate production policy. And before, they would have to wait 6 months. So I do think, again, it was a win for the White House, But I do think OPEC will be watching very closely to see if this new COVID variant does actually impact demand.
Got it. So, as you said, it's a win for the White House. Do they feel invigorated and feel that they were justified in the SPR release and in their strategy after what seems to be a couple of months where it just wasn't clear what was happening?
I mean, I do think that they feel that they were able to accomplish through diplomacy, getting the Saudis and the Emiratis and the Kuwaitis, but really getting the Saudis to do something which the White House thought was important in terms of trying to deal with issues of inflation, which are very, very, front and center in this country. So I do think they feel like actually employing sort of the deft diplomacy was really important in getting this outcome.
Yep. Thanks, Halima. I want to go to Greg now and just talk very specifically about what's happened to oil price in the market over the past week or so. We've seen dramatic drop in price. I'd love to your take on what caused that, and where. I won't ask you where you think it's going, but what do you think the key drivers are outside of some of the stuff that Halima talked about?
Thank you for having me on the panel, and being part of this is a real honor. And you're welcome to ask me where I think it's going. It's kind of what I have to do in my job. I get asked that a lot.
We'll save that for the end.
Okay. So one thing I feel like this is the third panel I've been on this week on the similar subject. The dramatic move was on Friday when you had basically a 1 in 1,000 day statistical move in oil prices down. It was down in a low liquidity day. If you look at how that created a cascade of problems in the market, you don't have to look any further than the vol market, where put skews are the difference between low prices for puts in the $40-50 range versus at the money puts. So basically, it's like a measure of stress in the market, and it's a measure of positioning problems in the market, because producers tend to be big buyers of these puts. So investors and merchants and market makers are the ones who sell it to them. So a big price moves down. Sometimes you can see where the pain is in the market, because what the investors sold will move disproportionately relative to other markets. Like it's traded this week or 2 days ago at a level that you saw basically back in March 2020. Massive distress there. And I think that was accentuated by the fact you had a major market move on a day that was very low liquidity, very few people working, particularly in the United States. And I think that created a cascade of issues. And that accentuated the move down. If you look at things like refinery margins, physical crude oil markets, the change was actually relatively small, certainly relative to the magnitude of the price move. And if I look at the change in implied balances, OPEC, the SPR release, 65-ish to 70 million barrels, of which vast majority, 50 million or more are going to have to be returned, is like a relative drop in the bucket. It's not a very big impact. And if you look at like the increase in OPEC production, it's not the 400,000 barrels a day they're talking about, because they haven't been able to meet that in the past 6 months. They've been actually increasing on the order of like 250 to 275. All of these numbers are actually really quite small in the grand scheme of things. So I think a lot of it had to do with the fact that there was a tremendous amount of optimism in the market. And then you just had a few small things working against it. And it created this cascading effect, and it created a lot of pain among positioning of investors and market makers. And I think that accentuated. But if you take a step back, $71 where you were before I walked into this meeting, I mean, that would have been a huge success 8, 12, 14 weeks ago. I mean, it's only because the market had gotten itself up to 80, 82 and was romancing, and you had a lot of economists out there talking about 90, 100. There's even a bank talking about 125, some talking about spikes then retrace, but it was a very optimistic outlook. And when I take a step back and I say, well, are we a little bit surprised that like the most bullish the market has been in a couple of years ended up having a setback? I don't really think so. And like, the thing that I think is also really interesting, if you look at 2022, demand and non-OPEC supply are roughly at the same level as 2019. And yet the market is now talking about prices and super cycle. So I think it was a positioning issue that really accentuated this move. And the fact that it happened over a holiday weekend, I think really made it much worse than it otherwise could have or would have been.
Greg, thank you. That's really, really fascinating. We've got a question from the audience that's for Halima, but I want to ask you first the same question because you mentioned it on the SPR. Do you think that there ultimately will be a take-up of the barrels released from the SPR? Will there be buyers? Where's that going?
So yeah, so actually the flattening of the term structure, meaning the front prices, the front value of oil relative to 12 months and 24 months forward has compressed a lot. So if you go back 3-4 weeks ago, each month was trading above roughly about $1. So you had $10 plus 1 year forward discounts to where it was in the prompt. So if you're if you're the SPR and you're looking to sell, someone can basically offer to return it back to you at a significant discount in the future. So the economics work to make that exchange successful. And if you look at places like China, Korea, like that's going to be exchange barrels also effectively. China really tries to do it on a 90-day rolling window. They may extend it, but if you get to the point now where the spreads are 30 cents a month, once you add basis risk, so that the risk that your price is difference to the listed price, plus the spreads, plus the cost of financing and the cost of actually scheduling, injecting, withdrawing, the economics really don't look like they work, or they're very, very strange. So the SPR would have to be willing to accept some very, very, very low bids relative to where the curve is trading to be able to sell them, I think. So in my view, it's going to be hard for exchange barrels to move out into the market. And it's another one of the reasons why I feel like some of this is an overly exaggerated move in the market, because it's still really small numbers in the grand scheme of things.
Thanks, Greg. Halima, since the question was actually directed to you, do you want to hop in on this?
And I'm happy to. I think Greg basically covered most of that territory very well. I would just say when they made the decision to go forward with the exchange mechanism, I think they were fully confident based on their conversations that they did have buyers and that it wouldn't, be a fail. And I do think actually the exchange mechanism was very important in terms of the sort of politics of the SPR, because that made it at least credible when they said we would do this again. Because obviously, without the exchange mechanism, people would say, well, you do one-time release, but are you going to continue to go back into the market? I think they believe that the exchange mechanism gave them a way to basically be credible in terms of saying like, hey, 6 months out, like if prices are not where we want them to be, like we are prepared to do it again. And I think that was part of the conversation with OPEC was we can do this again.
Halima, thanks. Paul is raising his hand, so I want to go to Paul.
If I could be the contrarian here, with regard to the SPR, it's insufficient. I'm not sure why the reaction was so strong. It's 1/140th of our use of oil in a year. It's less than 2 days. It's playing on politics because people don't know the numbers, so people reacted to that. Also, the thing that drove this thing forward was the alleged very high gas prices. If we look at real gas prices over the last 100 years, this is really not out of whack. And if we take a look at gas prices in Europe and throughout the rest of the world, US gas prices are pretty low. So a lot of the politics here is not based in the reality of gas markets or in the reality of the SPR market. And I think what the success was, going back to what Halima said, was the diplomacy gambit. It wasn't the SPR that pushed the Saudis forward. They know what the numbers are. And going over there and talking with him is important. Face to face with the Saudis is very important, but they're in the middle of their own energy transition right now. And if prices get too low, that may force them further into an energy transition. When the prices dropped in 2014, that's when 2030 came out. And that's when MBS and others started to get very nervous about what's happening. And this is happening in Saudi Arabia right now. I'm giving a talk in a couple of weeks on that, so it's pretty much fresh in my mind. Thank you.
Paul, thanks so much. Now, Rod, we haven't heard from you yet, so I'd love your take on what's happened, but also you're at Eurasia Group. Politics First, I think, is the the slogan. So I'd love your take on the geopolitics of these decisions and how you see this diplomacy working going forward, particularly in this world where inflation is a real concern of any number of governments. And so and the price of oil is at least a part of the driver of some of these high inflation numbers we've been seeing.
Great pleasure to be here, and thank you very much. Sitting on a panel like this, it's often sort of difficult to sort of add anything new, so I'm going to sound slightly like an echo. But I would repeat two things, I think, from the geopolitical aspect that certainly are striking to me. One is, and it goes back to something Paul just said, relates to, what is driving the Biden administration to do this right now. And the disconnect between focusing on crude and crude prices when it's gasoline prices that are essentially top of mind. And I think it's indicative of the extent to which inflation and gasoline prices as an indication of inflation is really driving the administration in the short term in terms of passing the Build Back Better legislation and passing that spending bill, and the need to be seen to be doing something. So I think, from that aspect, it is, this is as much a U.S. domestic political story as it is an OPEC story or a geopolitical story. And the amount of effort that the Biden administration has put into this, the ability to cajole and get a coordinated response from other consumers, the diplomacy itself, all really comes back to a question, I think, of wanting to drive a signature piece of legislation and get that through Congress as quickly as possible and as effectively as possible. And gasoline has been central to that. The second point, and it comes back to the politics first, and this is something that's echoing sort of what Halima said and what others have said. OPEC essentially went into this meeting having to balance three pressures and three relative pressures and deciding sort of how it was going to act. Those pressures were price, they were the politics, and particularly the relationship with the US. But I think also crucially something that Halim has mentioned a couple of times, which is the precedent of big consumers, but particularly the United States, engaging in short-term market management sort of efforts, almost as an anti-OPEC. And something that sort of stands there as a potential, challenge to OPEC's role in the market and challenge to the conversations and the way this has been done in the past, which has been about pressure. Bringing pressure, using diplomacy, being able to cajole OPEC to act, but not actually doing something, on a physical basis, as the SPR and the exchange really is. And I think, from a market perspective, if one were to step back, I think, and again, Halima mentioned this, if you look at where, from a market perspective, and where OPEC and the Saudis would traditionally have moved and acted, given the direction of markets, whatever the reasons for that, the direction of prices, a $15 a barrel drop from the previous OPEC plus meeting, and a potential to go south with a market that was seemingly turning a little more bearish. I think OPEC has been very good in the past at reacting to that. It's proactive in terms of taking measures to stop a slide. It's happier to sort of take some time when the direction is in the other way. And I think, if you'd looked at it sort of, again, from a general market perspective, you'd have said price would have been more important than the politics and the precedent. The reality is that it is the politics and the precedent that seemingly has been sort of foremost on their mind. And as I say, that goes back to, I think, saying something about where the Biden administration is and what it is willing to do to move its legislative agenda, and the extent to which geopolitics is going to be a part of that, and geopolitics is going to be affected by that.
Rod, I'll tell you this. I've heard from inside the administration that just thinking to the midterms next year, this was sort of earlier this fall. The sense was Afghanistan would not be the issue. It would be the price at the pump would be a much bigger driver. And so you see, it's this legislation that they're trying to get through, but also thinking out a year ahead, that they recognize that's going to be turning people sour on the administration and on Democrats in general.
And I think that if you look at the market, then the market moving forward, you look at some of the numbers that come out of the EIA and others. You look at sort of some of the production numbers that are anticipated for non-OPEC and particularly for the United States. What you would have to say is sort of moving into next year, you were going to have a softening market. I mean, OPEC has done a really impressive job of unwinding storage. And OPEC has done a very impressive job at putting itself in the driver's seat to be able to manage the market on a monthly basis, as Halima mentioned, and to be able to take short-term measures to keep prices at a particular level. That was always looking to be more difficult next year. Now, the volumes may be less than certainly the headline numbers, but what you are potentially doing is driving the market in a slightly more accelerated fashion into surplus. And I think as you look forward next year, the over optimism of a market that kept prices in the 80s was probably unlikely to persist. So I can understand that was part of the measure. Absolutely. I mean, you go into any election and it's the politics. It's the economics that sort of really matters. I think there was a famous US president that sort of mentioned that at some point. I don't think that has changed. So I think inflation more generally is a worry. I think what you've seen out of Jay Powell has sort of indicated that, and you can see it playing into some of the concerns also, as I say, in terms of the passage of legislation. But yes, you don't want high prices to be something that you're having to deal with as you move into an election period.
Right. I want to pick up on something you said way back at the beginning of your comments on the U.S. and other consumers working as a sort of anti-OPEC to try to balance the market or get the prices that they want. The Biden administration's approach, different than Trump's approach. I wouldn't even call it the Trump administration. I'd call it Trump's Twitter approach. How do you feel? And I'll ask you this, and I want to go to Halima on this as well. What do you think is more effective? Was more effective with OPEC, intervening via Twitter or this longer term diplomatic strategy?
I'm not sure that it's a case of which is more effective. I think two things I would say. One is it depends on the circumstances. Certainly, when OPEC gets into a pissing match, as I believe is the technical term, as it did in 2020, and cratered prices. I think having a Twitter storm sort of plays to an instinct that is already there. I mean, none of the OPEC countries really wanted to live with prices that low, and encouraging OPEC to take measures that would actually raise prices. I think you're playing to the crowd there. The Biden administration had a tougher job, and arguably what it was able to achieve through this diplomacy is impressive in terms of getting OPEC and getting the Saudis to act contrary to what I would have said was their financial and political economic instinct. So, being able to bring politics first there. But the point that I was making was also that, for the United States, this is a new type of move. I mean, the SPR has obviously been there since the 1970s, but, Halima mentioned 2011. That was, using the SPR through a broader IEA agreement, and it was about physical disruption. I mean, you could point to physical disruption in the market and the need for an emergency response. What the administration did here wasn't an emergency response. What the administration did here was chose to use an exchange mechanism and make it very clear to OPEC Plus that it would be willing to use it again in the future as a market management tool. So you have the specter, whether you believe it or not, you have the specter of the United States and potentially, bringing China, which has done this before on a number of occasions, but bringing China and other big consumers on board and saying, we can counter OPEC measures in the short term. And I think that's a brave new world that sort of OPEC would rather not be part of.
Mm-hmm. Halima, your take on this?
No, it's so hard to go after the supremely eloquent Rod Al-Qadiri. But I think what also is fascinating is, did we actually think we'd be at this point when the Biden administration came into office with all the focus on the climate agenda, we really didn't know if they would be willing to make hard asks of OPEC. I doubt they actually wanted to be in this position. But I think what's interesting is, when President Trump would make these, public shows of like force with Twitter, with OPEC, privately, he was on the phone with Riyadh, and he had a very good bilateral relationship with the Saudis. So when he would make those asks, I think they were willing to pick up the phone. And especially if we think about 2018, when they put an additional 1 million barrels on the market, that was also in the context of the US pulling out of the Iranian nuclear agreement, a policy that Saudi Arabia very much supported. Things went a bit pear-shaped when the US issued 7 exemptions from importers of Iranian oil. The market tanked, and the Saudis were left wondering whether they oversupplied the market in doing so. But I do think what was, really interesting this time around was, this is a administration that hasn't particularly enjoyed a warm relationship with Riyadh. So it just speaks to the sort of higher hurdle they had to overcome in terms of, getting the Saudis to do something, which I totally agree was not necessarily in their best financial interest. So I do think it required sending that team over, sitting down for a multi-hour conversation about the US-Saudi relationship. I think Trump could pick up the phone and get what he wanted at times because of the broader nature of that bilateral relationship.
Can I ask a question for you, Halima, and others in the panel? We're talking a lot about the US impact on this. What about the intra-OPEC politics? Because I vaguely remember when they set down the current quota and production plan, it took a little bit more than a day or two. It was like several weeks, of which it was, from an outsider's perspective, extremely painful to negotiate. So like in some respects, yes, they have a pause as part of the discussion there, but hurting all the cats within OPEC to agree to any production policy, like even again, if some can't make the increases, and so the net is a lot less than the headline, I wonder to what standpoint is also like, well, we can finish this meeting in a day or two, or we could spend at risk the next couple of weeks hashing out what it would mean to make adjustments to all the quotas. Do you think that impacted their decision at all?
I'm happy to take this and pass it over.
Clearly that was directed to you.
Okay.
And then we'll go to Rod. And Paul, I think you also wanted to talk.
I think the big issue over the summer, which we saw play out in terms of the UAE and Saudi Arabia over their benchmarks, that obviously was a multi-week process. And I think there were some question marks really at that moment about, would certain countries remain in OPEC if they didn't get a change to their benchmarks? I do think after that dispute that occurred over the summer, I do think that they're relatively on the same page. But with that said, I think Saudi Arabia remains first amongst equals when it comes to OPEC, that essentially you had to get Saudi Arabia to make the decision to not invoke the pause clause. I think that if Saudi Arabia had wanted to invoke the pause clause, I think they could have carried the organization with them. I think that essentially they were the most crucial player in that conversation. They remain the driver of the OPEC bus, obviously. And I'd also say that, His Royal Highness Prince Abdulaziz, if you watch the OPEC press conferences, he really sees himself personally as the central banker of oil. He talks about him, very much in the Greenspan model. So I do think he is somebody who you have to have the conversation with just because of where he sees his role in Saudi Arabia's role in managing the market.
Thanks, Halima. Rod, you had a comment on this?
Yeah, no, I couldn't agree with Halima more. And I think we're going to sort of exchange compliments on who's more eloquent. But, she's absolutely right. I don't think this was an issue in terms of this. But it's actually, Randy, going back to the comment you made about the longer term impact. I think as you look forwards in terms of OPEC, there are really sort of a couple of issues that stand out there in the next 2 years, certainly. And maybe a little further beyond, that are going to potentially plague the organization and plague sort of OPEC plus more generally. I think this issue of market share is going to be one of them. As you get, I mean, part of it is going to be, needing to get beyond COVID, which apparently is never going to happen. But, if it ever does, and we do get beyond COVID, and you get into a world where where that isn't an element of concern in terms of the market, and you're not recovering, or you're not still in recovery mode, that issue of market share is going to be there, because there's absolutely a debate going on amongst a number of OPEC states as to sort of where to position themselves for the energy transitions. And I think so that will get reopened, and it will get reopened on the basis of investment plans and, what we're talking about in terms of potential spare capacity. I think the second one that stands out there is Iran. You have 1.5 to 2 million barrels a day just waiting to come back to the market. And at some point, if you did get some progress, I think, on the Iranian nuclear talks, that is going to add a new dimension to the market, and is going to add bearish pressure to the market that I don't think anyone is quite prepared for right now. So, I think the more complicated discussions are to come. And at that point, I think you're going to be fighting sort of a lot of bearish pressure in the market, and paying less attention to the US and much more attention to sort of where your financial balances are.
Rod, you mentioned that COVID may never end. For those South Park fans out there, there's an episode, a post-COVID episode, where the kids are 45 years old and seeing each other in person for the first time. So COVID may never end. Paul, I wanted to go to you because, as Rod mentioned, Iran, and I know we've talked about Iran, and I love your take on what you think the likelihood is of any sort of deal going forward, because that's, of course, very relevant to this conversation. And then we have a whole slew of questions from the audience, so I do want to get to some of those as well. There are some great ones in there. But let's talk about Iran for a second first, because that is a really important issue that is being, could come up in the next, could be a major influence in the impact in the next year or so.
If I could take an interlude to comment on the Twitter issue. Twitter exists. It's a very much insufficient way of doing diplomacy in 140 characters in English or in Arabic, with connotations being different. And when there are misunderstandings, real bad stuff can happen. And I've worked in the Middle East for about 30 years off and on, lived there for 7. And even when you know someone well, there can be misinterpretations. I would recommend to the Biden administration quiet diplomacy, personal diplomacy. Do not do Twitter, not at this moment. Now, getting to Iran, the last time, when the Iran deal was struck the last time, we had the crash of oil. And it was a pretty harsh crash, because everyone knew a whole bunch of Iranian oil was going to come onto the export markets, which is far more important than the production of Iranian crude. They may be able to get up to 3 million barrels a day, even if, their fields are pretty broken up. They have not had a lot of investment in them other than Chinese and a few others. Whether they can get up to 3 million barrels a day quickly is a big question internally. Exporting maybe 1 to 2. What Rod said, 2.5 is what happened the last time this deal happened. I don't know whether this deal is actually going to happen the way many people expect it to. The new negotiators on the Iran side are hardliners. They have to deal with the hardliners in the Iranian public and in the Iranian parliament. This could slow down the negotiation. Also, my sense, my gut feeling, and when you've been in this business, not just the oil business, but the politics in the Middle East and all that for long enough, your gut is a place to check. And my gut is telling me they really don't want it. And if they really don't want it, certainly there are groups in Iran that don't want it. The people who are making money from smuggling past sanctions, and there's a lot of that. And most of the Iranian oil is ending up in China through shadow ships and ghost ships. They turn off their AIS beacons and kind of go through the world, people, quote, not seeing them, even though I'm sure satellites are looking at them all the time. I'm not so confident there will be an Iran deal. Of course, this may be a pie in my face in a couple of months. But there are a lot of pressures to not make this happen. And my sense is they're dragging their feet in order to develop their nuclear program. And they've already got up to 60% enriched. And if you take a look at the SWU, Standard Work Unit curve for nuclear enrichment, that's about 90% to weapons grade. 20% is about 65 to 70%. They've been playing us. At least that's my view. And of course, some people in Washington may disagree with me. That will be not the first time that ever happened. But I've looked at this situation for a long time, been studying Iran since 1993. It's a complicated country. It's hard to tell where they're going to be going on this. But my sense is it's not going to be as easy as some people think it is. And it could be that the Israelis and others will want to intervene in some very complicated ways to push this one way or another. They do not want this deal. The Saudis do not want this deal. One of the biggest diplomatic problems we have with the Saudis, the Emiratis, and others is they think we're going to get closer to Iran. Delisting the Houthis really aggravated the Saudis. And the Houthis are supported by the Iranians. Not going after the Hezbollah as we might. The Iranians have a big curve, like a good part of the Middle East is controlled by their alliances and their satellites. And the Saudis and others are very, very worried about this. Inside of Saudi Arabia, they cause trouble every once in a while. Certainly in Bahrain recently, they caused trouble. Fortunately, the Bahrainis caught them before the trouble happened. But we can't go for an Iranian deal. Excuse me, I don't work for the government anymore, so I don't have to give a caveat every time I say something, and I can speak my mind. This is great. This is awesome. I can do this. We cannot go for a deal unless we go for a deal with the missiles as well. And getting rid of the terrorism that they're supporting throughout the region. Unless that is done, if we go for a deal before that, we've just embarrassed ourselves. And if people from the administration are listening, I'm willing to talk.
Paul, thank you. Does anyone disagree with that assessment? If you do, chime in. Otherwise, I want to pivot to a question from the audience. So, Halima, Rod, or Greg? Halima, you're chiming in.
Well, actually, I actually wanted to take a follow-up question, but actually ask Paul myself, because I think about 2019 where we had that spectacular attack on Abqaiq. And certainly when I was a young intelligence analyst, we always thought of Abqaiq as the mothership of the global energy system, the world's largest oil processing facility. And after that happened in 2019, which came on the heels of like a series of attacks on tankers and strategic pipelines in the region, I think a lot of people fade the idea of sort of Middle Eastern energy risk. And so I'm just wondering Paul's thoughts on, if we don't get a deal, what does it look like in terms of security environment? How much physical infrastructure is at risk? Just walk us through how it could evolve.
Well, that's a good question indeed. The Houthis allegedly sent those very well-controlled drones toward Abqaiq. I took a look and actually gave a talk to NATO about this. Those were real experts, very highly trained drone pilots had this. I don't think the Houthis have a lot of highly trained drone pilots. And if you take a look at the sphericals in Abqaiq, they were hit like you were in a firing range with a Glock 19 and you were an expert. Right in the middle, right in the middle, right in the middle, right in the middle. Do you think a deal with Iran is going to stop the Houthis from continuing this? Is it going to stop the Yemen war? Is it going to stop Hezbollah's terrorism? I'm not sure how this will play out. It depends on what the side deals are on this nuclear deal. Because we want to limit it, it seems. The Biden administration wants to limit it, and the Iranians want to limit it too. I would say expand it. One of the best things that's different this time is the Congress has not put a deadline on this. The last time it was a deadline of July 14th, and they're on that 10-star hotel on Lake Geneva, and they have to get this thing done. I kept on wondering, why don't they just hang around for the next 3 months? It's a nice place. Argue more about it. As soon as the Iranians heard July 14th is the deadline, they said, okay, we're going to dig our heels and we're not going to move. And that's why we got a deal that wasn't good enough. What will the lookout? Are we going to be able to control the extremists in Iran who have been involved in all kinds of bad stuff for so long? As soon as this deal passes, they're just going to go back to their summer houses, which many of them have because they've been very much enriched by the smuggling, and they won't start being involved in Iraq. They won't be involved in Syria. They won't be involved in Lebanon. Of course they will be. This deal is not going to stop them from doing any of that stuff unless there is a side deal that requires them, maybe one of those secret annexes that we always seem to have, but stay secret for about 2 weeks at most. I know what the underlying question in your question is. If we don't have a deal and the Iranians get the bomb, what happens? Well, what are they going to do with it? If they get the bomb, what are the Israelis going to do? If they use the bomb, please tell me what's going to happen. Vitrification of the deserts of Iran. If they attacked us or the Israelis with a nuclear bomb, all hell would break loose. Having a nuclear bomb is not the answer, but it may be an answer to keep them from being attacked on the edges in asymmetric manners. I didn't really expect to get into this, but this is something I've thought about a lot. And I think it's an important thing for oil markets too, because if this doesn't work, what will the Iranians do? Will they get their proxies to attack OPEC again? The thing that saved us then was the Saudis had positioned a lot of stored oil in tankers nearby, and they made deals to have the oil moved around the world to make it more even. And the price didn't go through the roof, as we all predicted for decades. If anyone hits OPEC, that's the Achilles heel, remember? The Achilles heel of the oil market. Sure. Well, it wasn't then, and thankfully the Saudis and others were set up for that. But we also took out the anti-missile program from Saudi Arabia. And they have an alternative in there now from other countries, but it's not as good as ours. And that caused a deep diplomatic rift with the Saudis. What's going to happen after we have a deal? Depends on what kind of deal it is. You think they'll stop working on the nuclear program? I am not convinced. I know that's a hardline approach to this, but on this issue, I've seen too much.
So I think we need to do another panel on just the Iran deal and oil markets.
Okay.
I want to pivot now.
Sorry for talking too much.
Well, that's actually that there's just very interesting, but it's taking it in a direction that is more long term. And I think there are a lot of questions just in the short term that are coming in from the audience. And I also in the end do want to get to the climate question that's coming in from the audience, but also that Halima raised as well, and how the administration approaches climate and the energy transition in the context of oil markets. But first, we have a question that points to something Greg said early on about these monthly increases that OPEC is not actually meeting them. That they're 400,000 barrels increase, but they're really increasing 250 or so. And there's a question from the audience. Is there a reason to believe that OPEC Plus cannot actually meet this production? Given low rig counts over the recent past, is there actual productive capacity surplus? And what do we think? And there's another question: what do we think about their actual spare capacity in the sort of more medium term?
Yeah,
and that's
so I guess I think the way in which I look at it is if you break the country composition of OPEC Plus into Saudi, UAE, Kuwait, Russia, and Iraq, and then everyone else, you will see a very big difference in the performance of the countries in that second bucket from the countries in the first. That second bucket has barely increased any output over the lifespan of this current quota increase system. And if you look at like how much they're producing under expectations, it's call it 500,000-600,000 barrels a day. And then you look at that first bucket, UAE, Kuwait, and Saudi, I have very little doubt that they will be able to meet their expected increases. They've demonstrated capacities well above here. Russia is the one I am the least certain about. They took them several months after they were if you look over the last year where they had higher increases than they were actually meeting. Now, they were producing above their agreed to levels by a modest amount to start off with, but when they were given increases, they weren't matching them. And recently they've caught up, but it's not like they are structured like Saudi, where they can just turn on the taps very easily. Now their drilling budgets are going up in 2022. So I think that they will be able to increase somewhat. But even if you look at the national forecast that they've provided, it doesn't really line up with the implied quota increases in 2022. So I really do question just how much spare capacity is left in the system. If they match their quota increases, I think we could be sub 2 million barrels a day by 3Q next year. And you could well be even less, which is a scary low number in an environment where demand is expected to be at least at 2019 levels. Like, to be back in a world where you had such low spare capacity, I think is a concern for sure.
Halima, you wanted to jump in on this?
No, I would just add that, the countries that are not performing right now, Angola, Nigeria, I think they're going to be the perennial underperformers. I mean, issues with, lack of investment, infrastructure issues, labor issues. They even had labor issues because of COVID. And so that's why there had been a discussion at the November meeting about whether countries that had more, Saudi Arabia, UAE, Kuwait, would essentially agree to make the 400 a real 400. And I think actually if they had decided to make it a real 400, have a compensation mechanism, they actually have one when you overproduce. If they had done a compensation mechanism for underproducing, I think that would have avoided an SPR release, actually. I think that is, the US had basically scaled back their ask to just making it a hard 400. And I think it is going to be just a small number of producers that have the ability to ramp up, and the others are going to remain challenged in terms of production.
But that's also where I think the internal politics gets messier. Does Russia get the same compensation capability as Saudi? And, anyway, I think that this is the easiest path for them.
Rod, what is your take? What will it take to get these underperformers back up to where they should be?
I'm not sure it's a case of back up where they should be. I mean, it's a case of investment and their ability to invest in their sector and to attract that. And at this moment in time, that's clearly a problem, both in terms of their own fiscal abilities and the international investment that they're looking for going into the sector. I think it's going to be one of those challenges that, as you go through energy transitions and go through this period of certainly skepticism in terms of, or a certain amount of skepticism in terms of sort of where long-term demand is going to go, you're going to continue to see that. Similarly, I think, the more that, I noticed sort of a question of whether oil companies were going to be tobacco companies, and sort of picking up on that. I think, what is going to be sort of hugely important as you do move forwards is access to capital and cost of capital. And, it may not be governments that step in to actually define the parameters of energy transitions as much as it is the financial sector. Moving, having its own standards, having its own demands for disclosures in terms of companies, having their own individual financial sort of investment groups, having their own desire to sort of green their portfolios, etc. I think that may be where you start to get some of those problems, and then you start to look around OPEC and look at it on a very different level, and that is really how clean is your production, and how ultimately how clean is your crude, and how cost efficient is your production. And again, that doesn't necessarily play into the hands of some of those countries that you've mentioned, but plays very much into the hands of the likes of Saudi Arabia, the UAE, and others who will be able and who are involved in active measures to make sure that their production is as clean. Certainly, Scope 1 and 2 is as clean as possible, and I think that's part of the plan to ensure that you are the last man standing, or you are the producer of the last barrel in the longer term.
So you referenced that question in the Q&A, and the first part of that question was actually, what will it take to get U.S. producers to be generating investor attention? So do you think that there is a world in which we just don't get enough investment, even in the United States, which of course is stable and relatively clean, et cetera?
Yeah, I was trying to avoid that first part of the question, but
Well,
thank you, Andy.
I noticed that.
Thank you for bringing that back.
Yeah,
Look,
no,
I
I'm
think,
happy to do so.
I think in part of the US is looking at the nature of particularly US unconventional, and the nature of the companies that were there, and the nature of the pattern of that, and what it meant in terms of returns. I think these were obviously companies that were delivering production, but weren't necessarily delivering returns to investors. And investors, we're already getting shaky in 2019. I think as COVID came in, that imposed a level of capital discipline that didn't work with the US shale market. So I think as you come out of that, and you've seen a certain amount of consolidation, I mean, the question becomes, can you run that industrial process and still deliver the kind of returns on a regular basis that investors traditionally associate with oil and gas companies? I'm not sure that we have reached a point yet where that is necessarily sort of decided. And I think, the chances are that may be at a higher oil price level than when we went into 2019. So I think, that the upside of that is going to be capped. I mean, more generally, I think, companies, in particular large companies, haven't necessarily performed well in the market, haven't necessarily performed well in terms of their total shareholder return. Have been forced to sort of focus on dividends and buybacks, as they seek to, keep their investors and shareholders happy. And that is obviously going to limit the amount of money they can put in the upstream, and limit the amount of money they can dedicate to capital allocation and reinvestment. Add that to, as I say, the need at least to be seen to be greening your portfolio, at least to the need to be seen to investing more in renewables, and a sense that investors are focused on that. And you have oil companies going through a difficult period of time. As I say, it doesn't necessarily mean they become the tobacco companies. I think that's going to be more on the, how they're viewed by the financial sector. But in terms of their own capital allocation options, they are certainly constrained in terms of reinvestment by needing to keep shareholders sweet, and, as I say, by needing to be shown to be taking active measures outside their traditional oil and gas patch.
Rod, thank you. Greg, I saw you take yourself off mute. Does that assign you have a comment?
I just saw that it was a question in the queue. I don't know. I was preemptively thinking about it. I agree. I think the return on capital for these energy companies need to move higher. I think the biggest challenge you have for the industry overall with regard to how ESG is impacting them is if you look at how to allocate for any long life project, and if you have a investment fund that has to, or investment horizon where you have to value the 7-year forward outlook as much as the first 7 years, because in 7 years you're going to need to find a buyer for these assets. It's very complicated in the ESG background, particularly if you believe that you're going to be in a period of increasingly anti-hydrocarbon from either the demand or the supply side environment, whether it be increasing costs for operations, which could potentially hit you, and it's a liability that you have to underwrite, or whether it could be a decline in demand, or certainly at very least a meaningful deceleration for refined crude oil demand. And I think one of the things that I want to add to the conversation, and when people talk about medium-term demand outlooks, a lot of people will debate whether or not we're going to peak in 2027, 2030, 2035, or even later. I think the one thing, if you look underneath the hood, a lot of what ends up happening is the peak in crude oil demand, like refined crude demand, happens way before that, because a lot of the demand growth that is happening comes out of natural gas liquids, ethane, propane, much of which is produced actually out of associated natural gas, is not actually produced out of a petroleum stream. And then you add all the drop-in fuels, renewable fuels that are competing into the transport sector. Your demand for peak crude oil demand is going to peak way before your total demand for hydrocarbon in the transport sector. And I think when you start looking at those investments and you impose an ESG framework to it, the 7-year outlook is something that's very, very tough to write. Now, people, I think, are willing to be very, very willing to underwrite a lot more risk in the renewable side when they're making investments than the hydrocarbon side, and that probably doesn't work out as well for them either, because the merchant risk at the tail end of those projects is also very high. But I think it overall goes to the challenge, and to simply summarize, the challenge at deploying capital in this space is going to be very high because the ESG framework is and the challenges to these industries. So they're going to need to prove a very high cash return on cash for investors, I think, to continue to motivate capital to come in. I think you look at the 1990s as a template.
Greg, thank you. I see Halima, and then we'll go to Paul.
And I guess it's almost coming into the closing comments now that we only have 5 minutes left. But I would just pick up on Rod's comments just about last man standing, and I do think it's going to be a very challenging conversations within OPEC over the coming years in the transition, because you clearly have this small set of producers with cash on hand that have the low cost barrel, the low emissions barrel, that are going to just continue to invest. And even if the pie shrinks, they're going to have that dominant share of that pie. And I think that they're just going to be a lot of producers that just won't be able to stay in the game and are going to have real sort of political and economic and social challenges in the transition. So, Nigeria underperforming on its OPEC quota now, I think it's just a sign of what's going to be coming for that country in terms of other societal challenges in a transition.
Yep. Thanks, Halima. And the risk that you see to those countries that underperform and don't keep producing. I mean, the economic risk, the political risk in those countries just gets magnified there. So definitely something to watch. Paul.
Well, going back to what Greg said about the return on invested capital, the other part of that equation is the weighted average cost of capital. The return on invested capital has to be greater than that. But as we head toward increasing interest rate times, and I'm pretty sure we are going to that, the return on invested capital has to go up. And if you're looking at a country like Angola, where most of their oil comes from ultra deep water fields that are very expensive to get the stuff out, who's going to invest in Angola? Unless it's a political diplomatic decision. Nigeria, instability is increasing, not just near Port Harcourt or offshore, but also in the north. Algeria, politically questionable. And then the Congo and others. The volatility is increasing in the oil markets. The volatility increases risks, which means that you need to have a bigger difference between ROIC and the WACC, the weighted average cost of capital. And getting back to Greg's comment about the Russians, I've been reading about decline rates in Russia for years. I haven't seen the results yet, but they're investing a lot in the Arctic and other places outside of the Yamal. They have a ton of shale oil. I'm not sure about the cost of getting it out, but the Russians have a chance if their politics don't go awry. And Putin is not a young man anymore. What happens when he's not around?
Well, I think that's yet another topic for a panel. We are running short on time, and I want to make sure that Greg, Halima, and Paul have all said sort of what could be considered final thoughts. So I also want to give Rod a chance. You've got a minute or less to say anything in conclusion.
Actually, the only thing I would say in conclusion, and it follows on from Halima's comments, is when you look through energy transitions, the place of instability that most people focus on is the Middle East. And if you take her comments, which are very wise ones, and you play that out in terms of where you are likely to see the instability, the African continent starts to look like it has an even bigger problem over the next 20 years. And I think that probably is a really big takeaway from this that most people don't associate with the energy transitions debate. I'll leave it at that.
Rod, we did a paper with your colleague RJ on this very topic and released it in June. So definitely, I recommend everybody go and read that. It's called Shifting Gears, the Geopolitics of the Energy Transition. So I recommend everyone read that. We are now out of time. Obviously, there's a lot more that we could have talked about. I think we need to do another panel discussion very specifically on energy transition policies of the Biden administration and how those fit in with the oil market, because that's a question that we wanted to get to, and I know the audience was asking. We touched on it, but did not go deeply. So we will revisit that question. I think it's an important one. But for now, we need to end here. So thank you all for joining us. I really want to thank this fantastic panel. Really remarkable insights and analysis. So thank you again for joining us and being good friends of the Atlantic Council. I also want to thank everybody in the audience and everyone who helped put this event together, including Patty Ryan, Reed Blakemore, Zainab Wirinen, Michael Matier, Katie Kenny, and Madeline Howe. Please join the Atlantic Council Global Energy Center for upcoming events. So next week, December 7th at 3 p.m., we're hosting a discussion with Rod Caldwell, the Chief Executive Officer of Controlled Thermal Resources. And this will be on lithium recovery from the Salton Sea geothermal brine. So really interesting. And then there'll be more coming up later this month, as well as our Global Energy Forum in January 15th and 16th. In Abu Dhabi. Some of these same questions will be asked then. Please come visit us come to us in Abu Dhabi, or you can watch online. That's it for now. Thank you all very much, and see you soon.